Welcome back to Management Accounting. In this video, we are going to cover the absorption costing and marginal costing. In this video, we are going to learn the concepts behind marginal costing as well as absorption costing. Then we are going to identify the advantages and disadvantages of each method. Now, based on the theoretical concepts, in the next stage, we are going to prepare the profit statements under each method. Finally, we are going to compare the absorption costing profit and marginal costing profit in the reconciliation statement. Now let's see, how do we account for cost? So there are two methods of cost accounting. First one is marginal costing and the second one is absorption costing. Let's understand the difference between the marginal cost and marginal costing. Marginal cost is the variable cost of one unit of product or service. In marginal costing, only variable costs are charged as cost of sales. So the contribution is calculated by deducting the variable cost of sales from the sales revenue. Closing inventories of work in progress or finished goods are valued at marginal or the variable production cost. Then fixed costs are treated as period cost and charged in full to the profit and loss account of the accounting period in which they are incurred. In the marginal costing, the profit measurement should be based on an analysis of the total contribution. That is, sales value less the variable cost of sales. Let's look at the absorption cost and absorption costing. Absorption cost is the total cost of one unit of product or service. Total cost means variable cost plus the fixed cost. In absorption costing, fixed production costs are absorbed into the product units using the predetermined overhead absorption rate. That is based on the normal level of production for the period. Inventory values using the absorption costing are therefore greater than those calculated using the marginal costing. If the actual production is different from the normal level or the actual expenditure on fixed production is different from than the budgeted, then there may be an under or over absorption of fixed production cost for the period. Do you know what are the advantages of using marginal costing? We all know that it facilitates short-term decision making and it is simple and easy to understand. It is easy to calculate since there is no need to calculate the overhead absorption rate. We know that overhead absorption rate is based on different bases and it's complicated. And marginal costing avoid the need of calculating this OAR. And because of that, it's avoid over or under absorption of overhead. And finally, it helps to compare performance between two or more products and departments easily. Let's look at the advantages of using absorption costing system. One of the main advantages of choosing the absorption costing is the gap compliance. At the same time, it is confirmed with the international accounting standards. The accounting reporting standard allows the inclusion of the fixed production overhead cost in the valuation of inventories. Hence, the use of absorption costing method will be help in the preparation of the financial statements. Absorption costing take into account all the cost of production, not just the direct cost, as in the case of marginal costing. Absorption costing include the company's fixed cost of production, as well as salaries, rents, utility bills, etc. So it will give a more complete picture of cost per unit for a product. At the same time, it's useful in the price quotation. Absorption costing method is most useful in the price quotation because it covers all the production cost. And the use of budgeted information based on the organizational experience will give a better accuracy in the price quotation. Further, it enhances the performance measurement. The use of budgeted information to calculate the overhead absorption rate make the comparison of the budgeted and the actual information possible, which is used to measure the performance of the production department. Further, it enables to track the profits. Absorption costing provides the company with a more accurate picture of the profitability than the marginal costing, because it covers all the product cost. And if the products are not sold during the same accounting period, then it enables to cover and anticipate the seasonal variations and the cost in a better and accurate manner. Let's look at question 1. P&A makes a toy that has a variable production cost of 6 rupees per unit and selling price of 10 rupees per unit. At the beginning of September, there were no opening inventories and the production during the month was 20,000 units. Fixed cost for the month were rupees 30,000 for production and rupees 15,000 for administration, sales and distribution. There were no variable marketing cost. If sales were 10,000 toys, assume that the normal level of activity is 15,000 toys per month and the budgeted fixed production cost were 30,000 rupees for the month. So you are required to calculate the contribution and the profit for September using marginal costing principles as well as absorption costing principles. In this one, first we have to calculate the contribution per unit. Contribution per unit is the difference between the selling price and the variable cost of production. So the selling price is 10 rupees and the variable cost of production is 6 rupees. Accordingly, the contribution per unit is 4 rupees. So let's prepare the marginal costing income statement. So first we have to take the sales revenue. That is the selling quantity of 10,000 into the selling price of 10, which is 1 lakh. Then we have to take the cost of sales. So here, when we are going to take the cost of sales, we have to take into account the variable cost only. So here, first we are going to take the opening inventory. Since there is no opening inventory, the value would be 0. Then the product cost. That is 20,000 of the production units into the variable cost of 6. That is 120,000. Then we have to take the closing inventory. That is 20,000 we have produced. Then we have sell 10,000. So the balance is 10,000 units as the closing inventory. Then it should be multiplied with the variable cost only. That is 60,000. So the cost of sales figure is 60,000. Then the contribution is selling price minus the variable cost of sales. That is 60,000. And the contribution is 40,000. Then from the contribution we have to deduct all the fixed production costs as well as fixed admin, sales and distribution cost. So ultimately we are getting the marginal costing profit as this. Let's look at the second method of calculating the marginal costing profit. In this one, we are focusing on the contribution first. So the contribution is the selling price minus the variable cost, that is 10 minus 6. So the contribution per unit of 4 rupees should be multiplied with the 10,000 units of sales. Then the contribution we'll get is the 40,000. From that one, we have to deduct all the fixed production costs of 30,000 as well as admin, sales and distribution cost of 15,000. So ultimately, we are getting the net profit as 5,000, which is negative. Now, we have to calculate the overhead absorption rate. Overhead absorption rate is the budgeted production cost divided by the normal activity level. So sometimes in a question we may get the budgeted activity level. At the same time they may mention the normal capacity or the normal activity level. In that case, to calculate the overhead absorption rate, we have to use the normal activity level. So in this one, budgeted cost is 30,000 rupees and the normal activity level is 15,000. So overhead absorption rate is 2 rupees per unit. Now let's calculate the full cost of production, which is variable cost plus the overhead absorption rate. That is 6 rupees plus 2 rupees. So the full cost of production is 8 rupees. Let's see what is the over or under absorption of the fixed production cost. First we have to take how much of the cost we have absorbed. For that we have to take the full production units of 20,000 into the overhead absorption rate, which is 2. So the ultimate cost is 40,000 rupees. From that we have to deduct the fixed cost actually incurred in this question, that is 30,000. So we can see the fixed production overhead over absorbed is 10,000. So let's prepare the absorption costing income statement. Here also we are starting with the sales revenue, that is 10,000 into 10 rupees, which is 1 lakh. From that value we have to deduct the cost of sales. So here we are going to take the full cost, that is 8 rupees. Since there is no opening inventory, we have to move forward the product cost. So here the product cost is 8 rupees into 20,000 units, that is 160,000. From that we have to deduct the closing inventory, that is 10,000 into 8 rupees, 80,000. From that value we have to take into the account the over absorption of fixed production cost. Since it is over absorbed, we have to remove that from the cost of sales. So ultimately the cost of sales figure is 70,000. So the gross profit is 100,000 minus 70,000, which is 30,000. From that value we have to deduct the non-manufacturing cost, which is admin, sales and distribution, that is 50,000. So according to the absorption costing, the net profit is 15,000 rupees. So now let's take the same question, but here we are going to assume the sales were 15,000 toys. So based on that, we are going to prepare the marginal costing and absorption costing profit statement for the month of September. So let's calculate the contribution per unit. Contribution per unit is the selling price minus the variable cost. Here the selling price is 10 rupees and the variable cost per unit is 6 rupees. So the contribution per unit is 4 rupees per unit. Let's prepare the marginal costing income statement. First we are going to start with the sales. So since they are going to sell 50,000 units of toys, that should be multiplied with the selling price. So the sales revenue is 150,000. From that value, we have to deduct the cost of sales. Here, we are going to take the variable cost only, which is 6 rupees. First, we are going to start with the opening inventory. Since there is no opening inventory, we are moving to the product cost. That is production units of 20,000 into the variable cost of 6 rupees. So, the product cost is 120,000. From that value, we have to deduct the closing inventory. That is 20,000 minus 15,000 of sales. So, the closing inventory value is 30,000. So, the cost of sales is 90,000. Then the contribution would be 150,000 minus 90,000. That is 60,000. From that value, we have to deduct the fixed production cost of 30,000 as well as admin, sales and distribution cost of 15,000. So, ultimately, the net profit figure is 15,000. Now, let's see the easy approach of preparing the marginal costing profit. Here, we are focusing on the contribution. So, the contribution is the sales quantity into the contribution per unit. That is 10 minus 6 rupees. So, 15,000 into 4 is 60,000. From that value, we are going to deduct the fixed production cost, which is 30,000, and the admin, sales and distribution cost of 15,000. So, we are getting the same net profit figure as 15,000. So, let's calculate the overhead absorption rate for the sale of 10,000 units. Here also same, we are going to use the budgeted production cost and we are going to divide it with the normal activity level. Here, the overhead absorption rate is 2 rupees per unit. Then we have to take the full cost in order to calculate the absorption costing. That is the variable cost plus the overhead absorption rate. So it is 8 rupees. Let's see the over or under absorption of fixed production cost. First we have to take the fixed cost absorbed, that is 2 into 20,000 units of the production. That is 40,000 rupees. From that we have to deduct the fixed cost actually incurred, that is 30,000. So here the fixed production overhead over absorbed amount is 10,000 rupees. So let's calculate the absorption costing income statement. Here also we are starting with the sales. That is 15,000 into selling price of 10. So the value is 150,000. From that we have to deduct the cost of sales. Here we are going to take the full cost. Since we don't have any opening inventory, that value would be 0. Then we are going to take the product cost, that is 20,000 into the full cost of 8 rupees, that is 160,000. From that value, we are going to deduct the closing inventory, that is 20,000 minus 15,000. And we have to multiply it with the full cost, that is 40,000. From that value, we are going to deduct the over-absorbed production cost, that is 10,000. So ultimately the cost of sales figure is 110,000. So the gross profit is the sales minus the cost of sales, that is 40,000. Then we are going to take the admin, sales and distribution cost, which is 15,000. So the net profit figure is 25,000. Here, let's take the same question, but let's assume that sales are 20,000 units. According to marginal costing principles, the contribution is the sales quantity into contribution per unit. That is 20,000 into 4 rupees, which is 80,000. From that value, we have to deduct the fixed production cost of 30,000 as well as admin, sales and distribution cost of 15,000. So, the ultimate marginal costing profit is 35,000. Let's see the over or under absorption of fixed production cost. First, we have to take the fixed cost absorbed, that is 2 into 20,000 units of the production. That is 40,000 rupees. From that, we have to deduct the fixed cost actually incurred. That is 30,000. So here, the fixed production overhead over absorbed amount is 10,000 rupees. Let's prepare the income statement using absorption costing. Now in this one, the sales is 20,000 units and the selling price is 10, therefore the value is 2 lakhs. Then we have to take the cost of sales. In the absorption costing, we know that it is based on the full cost. So since we don't have the opening inventory, the product cost is 20,000 into 8 rupees, that is 160,000. Then we have to deduct the closing inventory. Here we don't have any closing stock. Therefore, the value is 0. Then from that value, we have to deduct the over-absorbed fixed production cost. That is 10,000. So, the cost of sales figure is 150,000 and the gross profit is 50,000. From that value, we have to deduct the admin, sales and distribution expenses, which is 15,000. So, the net profit is 35,000 when we are going to sell 20,000 toys. So let's see the effect of marginal costing and absorption costing on reported profit and inventory valuation. So you can see that when the inventory level decreases from 10,000 to 5,000, absorption costing will report the lower profit. And if the inventory level increases, the absorption costing will report a higher profit than the marginal costing. And if the opening and closing inventory volumes and the values are same, the marginal costing and absorption costing will report the same profit. We have given the following information related to the product Nova for the month of December 2022. So we have the selling price per unit, variable production cost per unit, variable administration and distribution cost, fixed production overhead, fixed distribution overhead. As well as we have the production and sales for the month as follows. So we have the sales actual quantity and budgeted quantity and production actual quantity and budgeted quantity. Then they are mentioning that the opening stock as at 1st of December 2022 was 200 units and the budgeted fixed production overhead and budgeted fixed distribution overhead is 175,000 and 250,000 respectively. Further, they mention that fixed overhead are absorbed on the production unit basis. So based on the given information, you are required to prepare the income statement under the marginal costing method for the month ended 31st December 2022 and you have to prepare the income statement under the absorption costing method for the month ended 31st December 2022. Let's calculate the income statement under marginal costing principles. So first we have to calculate the sales, that is 800 units into the selling price of 2,000. So we are getting 1,600,000 as the sales revenue. Then we have to deduct the cost of sales. This is based on the variable cost. So first we have to take the opening stock of 200 units into the variable cost per unit of 1,200. So we are getting the opening stock value as 240,000. Then from that value, we have to add the production cost, which is 1,000 units into the variable cost. So we are getting 1,200,000. So then from that value, we have to deduct the closing stock, which is 400 with the variable cost of production. So the cost of value is the 480,000. So ultimately cost of sales figure is 960,000. Then The gross profit figure is 640,000. From that value, we are going to deduct the other variable cost, which is administration and distribution. Altogether, it is 225,000. Then we are getting the contribution value. So we know that contribution is sales minus all the variable cost. So the contribution value is 415,000. From that value, we have to deduct the fixed cost. Here we have the fixed production cost of 150,000 as well as administration and distribution expenses of 250,000. So the profit value is 15,000 under marginal costing principles. Before preparing the absorption costing income statement, we have to calculate the overhead absorption rate. That is budgeted cost divided by the budgeted activity level. In this one, OAR for production overhead is 175,000 divided by 950, which is rupees 184 and 21 cents. And we are going to calculate the full production cost, which is variable cost plus the overhead absorption rate. So according to this question, the total cost is 1,384 rupees and 21 cents. So let's calculate the overall under absorption. So here the fixed cost absorbed based on the OAR of 184 rupees and 21 cents into 1000 units of production. So the value is 184,210. From that value we have to deduct the fixed cost actually incurred, which is 150,000. So we are getting the overabsorbed cost as 34,210. Let's calculate the income statement under absorption costing. Here also we are going to start with the sales. So the selling price into the selling quantity. It is same as the marginal costing, that is 1,600,000. From that value we have to deduct the cost of sales. So here we have to remember under absorption costing we are going to take the full cost of production. So the value is 1,384 rupees and 21 cents. From that value we are going to value the opening inventory, production as well as the closing stock. Then we have to take the over absorption of fixed production overhead, that is 34,210. So altogether the cost of sales figure is 1,73,158. So the net profit value is 526,842. From this gross profit, what we are going to do, we are going to deduct the administration and distribution cost, which is the non-manufacturing cost. So the value is 475,000. So the ultimate net profit figure is 51,842 under the absorption costing. Let's calculate the difference in reported profit. Under marginal costing, the profit figure is 15,000, and under absorption costing, it is 51,842. So the reason behind these two is the increasing inventory value, that is 200 units into 184 rupees and 21 cents. So the value is 36,842. So we can see that the differences in the reported profit under marginal and absorption costing is mainly due to the inventory valuation. Thank you. Hope you have gained some knowledge with regarding to the marginal costing and absorption costing. So if you want some more details with regarding to profit reconciliation, you can go to the marginal costing and absorption costing profit reconciliation statement video. Stay touch and keep watching.